The 10-year Treasury yield hit 4.31% this week. Futures markets are now pricing in a rate hike before year-end, and the strongest argument for that hike comes from a place nobody expected: artificial intelligence. Not AI replacing jobs, not AI cutting costs, AI making everything more expensive. The S&P 500 gained nearly 3% on Monday alone. The Nasdaq surged 3.83%. Airline stocks soared on Iran ceasefire hopes, as Bloomberg reported in Airline Stocks Soar, United American take off on war de-escalation hopes. Oil pulled back toward $101 a barrel. Risk appetite flooded back into equities. On the surface, the market looked like it had found its footing. But underneath the rally, something else was moving. Bond yields climbed. The 10-year pushed to levels not seen since last July. And according to Fortune's coverage of a St. Louis Fed blog post, inflationary surge, Fed economists warn AI hype is overheating the economy. The very technology Wall Street is betting on may be the reason the Fed cannot cut. Here is what the market is reading. Strong ADP employment numbers. ISM manufacturing beating consensus. Headline inflation sticky above 3%. Put together, the case for tightening looks clean. Goldman Sachs noted that investors are increasingly pricing in a rate hike, a dramatic reversal from the 6 cuts priced in early last year. But Goldman's own team says the market is wrong. The firm still expects 2 cuts in 2026 and laid out 4 reasons why a hike is unlikely. One of the most compelling: the data strength is backward-looking. ADP captures hiring decisions made weeks ago. ISM reflects orders placed before the Iran escalation repriced supply chains. The numbers say the economy is hot. The economy itself may already be cooling. Now layer in the Fed's own research. Economists at the St. Louis Fed argue that AI optimism is functioning as a news shock. Companies are spending on data centers, hiring engineers, and bidding up power infrastructure, not because AI is delivering returns today, but because they expect it will. Oracle just laid off up to 30,000 workers to redirect cash into AI buildout. Gas turbine prices are surging, Bloomberg reported, crimping efforts to power data centers. The spending is real. The productivity gains are not, at least not yet.
This creates a feedback loop. AI investment drives demand. Demand pushes up prices. Prices keep the Fed pinned. The Fed staying pinned keeps rates high. High rates increase the cost of the very AI infrastructure companies are racing to build. Goldman Sachs found that 80% of companies are not yet using AI in any meaningful capacity. The investment is front-loaded. The returns are nowhere. So the market is pricing a rate hike based on data that may already be stale and an investment boom that has not yet produced the productivity it promises. That is not a rate hike case. That is a misread. The weight of evidence leans towards Goldman's view. Cuts, not hikes, are the more likely path. The labor market is softening beneath the surface. Unilever froze hiring this week, citing geopolitical instability. GM and Toyota both reported lower Q1 sales, with Cox Automotive projecting a 2.6% annual decline. If the Iran conflict extends hiring freezes across multinationals and oil stays above $100, the consumer weakening visible in auto sales will spread. That is a cutting environment, not a tightening one. But this only holds if AI capital expenditure decelerates. If Oracle's layoff to invest playbook spreads, if more companies fire workers to fund infrastructure that does not yet pay for itself, the inflationary impulse from AI spending could keep the Fed trapped longer than Goldman expects. In that world, the hike pricing is not wrong. It is early. The number to watch: Friday's non-farm payrolls report. If job gains come in below 150,000 with a rising unemployment rate, the rate hike narrative collapses within days. If they print above 200,000 with wages still hot, the false signal becomes a real one, and the market will have been right for the wrong reasons.